Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. Pick up the phone, give us a call. This is the Mortgage Voice. I'm your voice in the mortgage industry, and I've been doing this show for about four and a half years, and I have never really seen the volatility that we're about ready to see in the rates in the market. Why? Because during that 4-year stretch, we had not the economy we have today. We have a roaring economy, and we have some things that are going to happen this week, probably, and by the airing of the show, it may have already happened. Quarter-point rate hike by the Fed will lead to some difficulties in certain markets. Certainly, car buying is going to be more expensive. Anybody out there doing a new car loan or anything on an adjustable car loan note is going to see their payments increase. Anybody that's in the credit card business, if you're one of these people that always moves from one credit card to another, let's say you run up a balance on one and you want to pay it down with zero balance on another. I know I've done that for a number of years, and I've done it when times are tough. Well, that's going to be more expensive now too, because rates on your credit card are going to go up and the terms and conditions are going to change. So a lot of these things that are happening as a result of the Fed rate hike is something to obviously look out for. For the mortgage rate, if we're looking at mortgage rates right now at 4.5%, let's say for a 30-year fixed, one thing you've got to pay attention to is when rates are risen or raised by the Fed. Powell over at the Fed is now in talks to do that. He will probably have done that already. And I say he, it's not really him, it's a committee, right? They have this Federal Open Market Committee meeting, and there's Fed governors, 9 of them from around the country, and they get together. And the chairman is the one who usually gives the recommendation, and they all vote on it. Sometimes there's some dissents, like a few months ago we had one of the Fed board governors from New York, I believe, say that, he didn't think of tightening right now would be a good idea. But I think we're going to have pretty close to unanimous vote on this. Why? Because, as I said, the economy is doing really well. I'm going to read some things from U.S. Trust that we take in about once every month and a half, and they send it to us about what's going on in the economy and the macro level. And that's really important, because when you're looking at long-term interest rates, you want to see how the economy is doing and how it's going to respond to the, as you know, we sell bonds in order to fund loans here in the United States. The bond market itself is the one that determines the rate for which you're going to borrow your money, and these are on the 10-year Treasury notes. So if you're looking at how is the Treasury going to raise money to pay for what the government does, it does it by selling bonds or notes. And in so doing, the rate attached to that is affected by many, many things. And one of the things it's affected by is demand, obviously. So if there is a lot of demand out there, and usually there's a lot of demand for treasuries when the economy isn't doing so well, or when world events dictate that the safe haven for your money or money around the world or big money in big funds goes to U.S. treasuries, because those things are as safe as it gets in worldwide investing. However, right now with the market being the way it is, and we've got some great news in terms of what's happening in the economy. Although we've had a GDP that's been revised from 2.9% for the year, the projection to 2.8%. Now that doesn't seem like a lot, but on $13 to $15 trillion U.S. GDP, that's a big number, right? So if it is being adjusted downward quite a bit low, and to give you an idea, during the Obama administration, during the Obama's last 4 years, we probably had growth rate of anywhere from 1.8 to 1.9%. Well, we've now, 2 years later, if we're projecting to the end of 2018, we have 1% growth increase, and that's a big, big deal. It probably has a lot to do with the taxes that have been obviously reduced. Corporate taxes are now quite a bit lower than they were. I think they're at 20% is the top rate corporate tax level right now, which means for you as people, that means that most companies, rather than pay dividends or pay increased salaries, what they're doing is they're hiring more, because they think the expansion is there, because they want to see, as well as corporate tax rate, obviously personal tax rate. My personal tax rate has been dropped from 25% down to 22%. So if this, in my tax bracket and my age bracket, means anything, it means you're going to have more money to spend. Oddly enough, what we've seen in the last 90 days and the first quarter of this year is that we haven't really seen consumer spending increase the way we should see it. Now, maybe that's because March 15th is tax day and everybody's trying to figure out the new tax code, figure out the new tax levels before they start spending their money. I'm not quite sure of that, but certainly on the corporate level, we are seeing increased spending. We are seeing, obviously, spending to hire more people. My son is getting out of college this year, and he's been out on 2 or 3 job interviews. And as I told him, hey, better now than 5 years ago, because the job market is actually quite a bit different. It's quite a bit better, and college graduates are going to find a lot easier time getting work. Okay, let's get to the U.S. Trust Market Minute that they put out for me, and I'm really happy that they do that and appreciate their sending it to me. On the macro strategy, retail sales surprise to the downside again, and this is what I was talking about. Consumers aren't quite spending as much as we thought. This is probably a payback from the Q4 surge in post-hurricane expenditures to repair flooded vehicles and homes. Okay, so maybe that's true. In Q4, it really skyrocketed a little bit because we had some awful weather, and the hurricane season certainly is one of those things, and we've had fires and floods out here in California as well. We also see, the unfiled job openings surge to an all unfilled. Why did I say unfiled? It's unfilled jobs. And this is what I was saying. We can't find enough people for the jobs that are currently being offered. And for my son and anybody else who's graduating out there, this is a terrific time to look for work. And the unfilled job openings surged to an all-time record high at the beginning of the year. And this is according to the latest job opening and labor turnover survey that they put out. And by the way, I get tons of these surveys. I'm a lender. Malibu Funding Inc. 79620. That's our NMLS number, who is the sponsor for this show and pays my salary each and every week. A little bit separate than the show, The Mortgage Voice, but it is obviously intricately interwoven. Anyway, they send me surveys every week from all kinds of federal governments, from all kinds of state government, and they want to know stuff. And they always look to have me tell them how we're doing, how we're hiring, what we're doing in terms of satisfying borrower needs. What are the borrower needs? What are the credit? It goes on and on and on. And one of the updates to some of the things that we talked about in overregulation, the CFPB is set to make some determinations on the HMDA regulations that are coming down in 2019. The HMDA regulations are simply this. They're going to ask for a registry of additional information which are more than demographic. We're going to be asking for loan size, area, just a number of things in order so that the federal government can look at my lending policies, mine, everybody else's who does lending, and I'm a very small company who does lending. There are huge companies, whether it's Wells Fargo or Bank of America or you name it, Chase, who do a tremendous amount of lending, like in the trillions of dollars, right? We're talking about in terms of their portfolio being vast. Anyway, I have a small company, and the amount of information that I'm being asked on each and every week grows. But CFPB under Mulrooney, I think one of those two names. Anyway, I'm sorry if I butchered it. Anyway, he is the head of the CFPB, is looking to redo the regulations so the HMDA, HMDA regulations are going to be revamped, hopefully, so that companies like mine are exempt. And that kind of information, which is so detailed and so burdensome on a small company, whereby I have to hire additional people just to do government regulation stuff, it seems an overburden. Anyway, if that goes away, that'll be a good thing. I'm Jeff Barton, your voice in the mortgage industry. We've got a great show lined up for you today, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. If you pick up the phone and give us a call, we can help you figure out whether you want to get a mortgage, how to get a mortgage, and what's the best possible option for you if you want to either refinance or if you're looking to buy a house and you need purchase information. We have a tremendous amount of agents that work for Malibu Funding. Malibu Funding is the sponsor for the show, and their NMLS number is 79620. And if you need an agent, certainly go to that website, malibufunding.net, and you can see all the different agents there. There's probably 35, 40 different agents. Malibu Funding is in 10 different states, so if you have needs in other states, or you just want to talk to us about what is it like if you want to get a mortgage in Texas or in Washington or out in the East Coast in Virginia or Florida or Georgia. We certainly have that experience, and we certainly have the people there who can help you. We try to bring experience every show to the show in order to make your life a little bit easier when you're trying to figure out what to do. I know it's not a simple solution when you just go to one person and that's it. It's not simple because who knows if that person really knows what they're doing. Malibu Funding been around since 2002. So if you're, again, looking for information about mortgages, yes, we can help. And I'd be happy to be the guy who can either direct you or give you the information myself. I know I've talked to 3 borrowers from Virginia this week, and all 3 borrowers have different scenarios, different questions, different opinions. And one of the things that we find when, we're a smaller company to those that like Chase or Wells Fargo or Bank of America or any of the larger regional players, and there are plenty of them, believe me. But if we, as a boutique, sort of smaller lender, and you come to us, usually you come to us because those other shops cannot help you. And one of the reasons they cannot help you is because as a lender, and I know this myself, you only have a certain number of products available. And those products are, by design, meant to be the safest, easiest, and best way for that particular lender or company to do business. Taking risky loans on is, again, risky. So if you can make more from easier, more, simpler loans to do. And what do I mean by that? A simple loan would be somebody who is a borrower who is a W-2 employee. They're making between $75,000 and $125,000 a year. And they're looking to either refinance or buy. And they have over 700 FICO score. And they have, if they're going to buy, 10 to 15 to 20% down. These are what we call cookie cutter loans. Why? Because that person is got a great job, they have a great credit score, and there should be the lowest rate for that type of person. And so therefore, if somebody is in that end of the business where those are the type of customers that they're looking for, they probably have a lot of those same type of customers. Therefore, that particular loan that they're going to do is going to get a great rate. And they do volume loan. They do, if you're Wells Fargo or, some of the larger banks, you're doing thousands and thousands of loans just like this every month. So those particular loans should be great. And by the way, if you are with one of the larger banks and you're looking to do a mortgage, you should be able to get a better rate than the rate if you're just looking to get a loan from anybody. Why? Because they already have your money. So you are giving them what they call full service, meaning that you probably have a credit card with them, you have your bank account with them, and you're about to get your mortgage with them. Maybe you have your car loan with them too, if you have a car loan. Maybe you have college debt that is also with them. This is the type of customer that there was a time 1 out of 6 people in America did business with Bank of America. Why do I say that? Because of all those 5 or 6 different things that you can get a loan on, Bank of America probably had one of those things with you. And 1 out of 6 borrowers in America, that's a lot of business. And believe me, if you're doing some of those, all of those, or just a couple of those with a major bank, you should be able to use that as leverage to be able to get a better rate on your loan, all things considered. Now, what we do in the lending industry is when we look at a file, we look at your ability to repay. I guess that's the most important aspect of what we do when we look at files. The ability to repay, the ability to pay back the loan. What's the likelihood? And this is required through Dodd-Frank as part of the qualified mortgage rule, and we talk about QM and we talk about non-QM all the time. QM is the type of loan that I'm talking about right now. It's a qualified mortgage, and one of the aspects of the qualified mortgage is your ability to repay. And that ability to repay the loan is the most significant aspect of figuring out whether you're going to get a loan. So if you've got this job and you're making between $75,000 and $125,000, and whatever your debt-to-income ratio is, and they figure that out, and then from that, based on your ability to repay or how much money you make or how many people are on the loan. And let's say in this scenario, there's only one person on the loan. You're the type of person that can borrow X amount of dollars based on that figure. And this all is, of course, predicated on the whatever the rate is. And the rate in general is determined by your credit score, your length of history of your particular credit score, meaning that let's say you have a snapshot of your credit score today, which is 704. And let's say that you've had that 704 for the past 18 months. But prior to that, you had some problems, right? Prior to that, you had some issues with your last home that you couldn't quite pay off, so that you had to get a short sale, or that you had a bankruptcy, or some other things within the scope of your credit score, which may not show up today in your snapshot of your credit score, but prior to the 18 months, you did have this. Well, since they've gone to the new trending credit score, it shouldn't affect your rate as much as it used to. Because when looking at your credit score, when looking at what goes on in your credit history, they are trying to now look at only this trending credit score, which is the last 18 months, 18 to 24 months. They're not going to go back further than that in general. They used to when it was just a snapshot, but now since it's not a snapshot, what we've got is this trending credit score. Anyway, when we get to the rate, and that rate is determined, again, by your credit score and also by whatever products are available out there. Like some lenders will be able to hit you with the lowest rate. And why do they do that? Because their service is terrible and they pick and choose who they want to. For instance, we talked about the cookie cutter loan, the large banks that do amazing amount of loans of a certain type of product. Yes, that is true. And those type of banks and those type of products, because of the way they do business, are able to offer you the lower rate. And in my latest scenario, because of the lack of service that you're going to get, and because they are choosing a certain type of loan that they consider the safest, and because their overhead isn't quite as great as some other banks because of the way they do business, they're able to offer you the lowest rate. Perfect rate conscious bank is Provident Bank. Provident Bank by far gives you the lowest rate almost ever, always, and has been doing so for 15 years. But they are difficult for brokers here in Southern California to work with. And by the way, I want to say hi to KCAA, KMET, the Roadrunner, and K-Tahoe, our affiliates and stations that broadcast the show. Really appreciate all the efforts they do each and every week to bring this information to our audience. So those people out there who are listening, who feel like they want additional information, I give you the information at the beginning of the show. Each and every segment, 888-713-2929 is the telephone number. If you want to email us, info@malibufunding.net. And certainly, if you want to see this show and you want to repeat and again, see it again, KCAA, you can download from there or go to themortgagevoice.com. And themortgagevoice.com will air the shows that you're currently hearing, because we do shoot this for TV as well. And you can get the shows that way. We also do that Las Vegas real estate show, which can give you some ideas about real estate in Las Vegas and what's happening out there in that particular market. Listen, this segment is breezed by. There's so much more to cover in terms of why mortgages are what they are, why the rates are what they are, and how we can help you discern what's the best avenue for you to take. But we've run out of time in this segment. Anyway, I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number. Pick up the phone and give us a call. We talk mortgages. We talk all things that have to do with buying and selling properties. Hey, if you're one of these people out there, it is springtime. I don't know. It's raining out there. I know it is. But if you're one of these people that wants to buy a house, it really is important to listen up to today's show. We have a lot of great information about people who are buying, people who are selling. If you're in an area that just doesn't have the housing, maybe you need to branch out a little bit, try to figure out how you can either borrow more money or be able to move to a different area that might be able to afford. Anyway, I'm Jeff Barton, and I really appreciate you all listening to the show and tuning in each and every week. We have terrific affiliates all over the Inland Empire. I want to say hi to everybody out there, San Bernardino and Riverside, as well as up in Tahoe, one of our new affiliates up there, and really appreciate those folks up there. They do a great job bringing our show to you. We bring to the show each and every week, great people and different people from all different walks of life. Why do we do that? Because when we talk about buying and selling real estate, we're talking about people. And those kind of people that we try to bring to the show have experiences in both being entrepreneurs as well as business owners, as well as experts in their field. And we do that, as I say, at least once or twice a month. We bring on those type of people. And with us is another person just like that, Jenny Kenyon, who's the director of track and endurance over at the Sports Academy out in Ventura County. Jenny, how are you?
Good. How are you today?
Boy, I'm fine. That was a heck of a long-winded intro. I'm sorry about that. I just was kind of droning on and on. I apologize.
No problem.
Okay, very good. So, at your job at the Sports Academy, now, can you just, for our listeners, I know you because I'm in your run club, and I've known you for a couple years, 2.5 years, but exactly a little bit about your history, what you do, and how you came to work at the current job you are.
Yeah, well, I'll try to give you a brief synopsis. It's been quite a series of events. But I started out as a college athlete and then became a college coach. And after deciding I wanted to still be involved in track and field and running, but just more in the private sector, I began my own business doing private coaching and training specifically for track, cross-country, and running. From there, business started Sports Academy in the Thousand Oaks area where I'm from, and they invited me to be the director overseeing the track and endurance programs at the facility.
When you run your own business, I mean, obviously it's not a simple thing to do, but I know you, and I know that you bring something to it. What drew you to wanting to work with runners and to try to open your own business? These are really interesting things to me.
Yeah. I guess the biggest thing is I think anytime anyone wants their own business, they do want to have their own time. They want to be on their own schedule and not to have someone else telling them, what to do and when to do it. But the biggest thing and what I wanted to do is I love people. I love coaching people, and it's more to me about the relationships that I can build with my athletes on a personal level than just necessarily the programs and the workouts. Those are something that I obviously use and grow in that area as a coach, but I really enjoy having the opportunity to work with people and not have kind of the rules and regulations of a larger organization telling me how to have those relationships.
Is this typical in terms of sports training outside of universities and pro teams? I mean, is it more of an individualized business, and is that how, I guess, people do it?
Yeah, I mean, it definitely depends. There's more and more organizations, especially as, high school athletics becomes a lot bigger, and a lot of people looking for that college scholarship.
Right.
There's a lot of larger organizations that are, like Sports Academy, that are looking to capitalize on that, and the younger youth coming up, wanting to develop great athletes. But ultimately, it is personal. There's a lot of parents looking for that personal attention for their kid to develop into, what they potentially could become.
Now, you obviously been doing this a while. There is a push-pull to this business in general, right? Especially the younger you get into private training. Should it be done? Shouldn't it be done? Are you adverse? Are you supportive? Where do you come out on that with younger children jumping into this kind of training?
First and foremost, I believe that running has to be fun. Training has to be fun. I think back when you and I were kids, and even farther, kids would go out and play hide and go seek with their friends, kick the can.
Right.
They'd play tag in the street, and nowadays you just don't see kids doing that. Either it's more dangerous for kids to be out by themselves, at a park. Both parents are usually working, so there's not the supervision that you have. And so a lot more, you're saying, more organized sport, kind of taking over what used to be our playtime.
I see.
So with that, for me, where I stand is, number one, I want the kids to have fun and enjoy being active, because that creates a lifestyle of being active.
Right.
And then I really want them to train with a coach that has that as the focus with the younger children.
Right.
Then making them into a Division I monster,
right,
or the next Olympic champion. That will come later, but ultimately you have to lay a foundation of just enjoying sport.
Yeah, I think so too. And I think there's a competitive aspect about training, about getting to the next level, but the fun aspect sometimes gets trained out of the athlete. I think that, and that's what they call burnout, right?
Oh, yeah, absolutely. And so it'll be interesting to see, because I'm seeing a lot more younger children coming through our programs, and, parents asking me to work with younger and younger children. So it'll be interesting to see how many of those kids, move on and enjoy doing it through middle school and high school and potentially college, versus what it has been in the past.
Now, you've trained athletes in all kinds of sports. I know that you had a particular athlon athlete, and you've done some endurance sports. What's your particular pleasure? I mean, what do you care about training the most, and what do you get most fun out of doing yourself?
That's a great question. I think I really do enjoy the youth aspect of it. Probably those kids that are about probably 10 years old, where they're a little bit more mature, more focused in what they want to do, and they're just more of a sponge. They just want to absorb everything you have to say. And you can see improvement in the younger kids so quickly.
Right.
And you can also just see, with each in that one session, just how much confidence they're building just by mastering a skill. And that, translates in all areas of their life.
Right.
So I think I enjoy that the most, because I can see that as having more lasting effect on their character in general.
Hey, what kind of races are coming up soon? I know you got one coming up this weekend.
I know. We have a great race of Agora
right,
coming up. It's I'll be running the 10K, but we have people running the 5K as well as half marathon, as well as yourself.
Yeah, I know. I missed that LA marathon. I got sick last week.
I know.
It's just
no fun to run a marathon when you're not feeling well.
No, I mean, it's pain enough, right? And I think
Exactly.
that's really prevents a lot of people from getting into running in general. I mean, the races are fun, but they're not necessarily races. A lot of people do them just to satisfy this thing that they have to do, like, I've got to check this off my bucket list, right? Well, what do you suggest to athletes, like older athletes who want to get into running and just enjoy it? How do you train a little bit differently with them?
Honestly, I was just talking to someone in the office about this, because they said they were signing up for a marathon. I said, well, have you ever done a half marathon?
Right.
And they're like, no. I'm like, I think that's this rite of passage that we all have to train for a marathon in order to,
right,
I don't know, check that box. I'm
right,
not quite sure.
That's true.
And I, for one, to be honest, have never completed a marathon.
Right.
Or do I want to? I feel I've been a sprinter my whole life, up until adult years, and it's, I'd rather enjoy a long run and feel good at the end,
right,
and enjoy the process of getting into shape, instead of having that, kind of almost a huge elephant. Some of these people coming from not running to then a marathon, start out with a 5K and with some friends, and then
right,
not even having a goal outside of finishing it.
Hey, listen,
maybe a 10K.
We are up.
Move up from there.
We are up against the clock. Thank you very much for all your time. I know you're busy. I mean, I caught you on the track, I believe, right?
Yep, headed out to practice now.
Okay, very good. Could you shout out your phone number in case somebody wants to get a hold of you over at Sports Academy?
Yeah, no problem. You can call me directly at 805-708-6600. 888-7171.
And that's Jenny Kenyon from Sports Academy. She's the Director of Track and Endurance. Jenny, thanks very much for coming on the show.
My pleasure.
Okay, very good. And I'm Jeff Barton, your voice in the mortgage
You're
industry. We'll be
listening
right
to
back.
The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is the telephone number. Pick up the phone and give us a call. If you want to email us, info@malibufunding.net. That's how you get in touch with me or anybody at the company, Malibu Funding. They are the sponsor of the show, and their particular NMLS number is 79620, and that's a very important distinction. Make sure that when you're out there and you're shopping around, those NMLS identifiers are very clearly identified for you so that you know that they're real and you can check up on them or find out more information about them from the NMLS in general or each and every state. Malibu Funding's in 10 different states. So if you are looking around for a good lender, somebody that can help you get a mortgage, we certainly can do that. The Mortgage Voice, we're on each and every week, and I appreciate those people who listen to the show. We bring great guests to the show, and Brian's been on the show several times, and he's back with us again. Brian Hewitt from Remen Real Estate Mortgage Network. Brian, how are you?
I'm doing very well, Jeff. How about yourself?
I'm fine, thank you, and I appreciate your letting me know about the error I made. You know, a lot of times I don't remember what I say a year ago, but you were very good today reminding me of what I said a year ago, and that's extremely important for someone in your end of the business, right?
Yes, sir.
Okay.
Yes, sir.
So let us know a little bit about how you're handling rate hikes and what's going on in the market with products that you guys deliver to people, especially rate-conscious people.
Okay. So, today's environment in the lending world, rates are going up. And what that has done is really dragged down the percentage of people who can actually qualify for a Fannie Mae or an FHA loan type thing, or regular conventional financing. And I'm in Orange County, California.
Right.
And I read an article yesterday that the affordability has dropped to below 17% of the population here.
Wow.
We consider 20% a flag for us.
Right.
In 2010, it was actually at 50%.
Wow.
So values have significantly gone up, and the incomes haven't followed them. So as you see rate hikes happening, when the Fed does theirs, and then the market dictates changes, it really does affect the consumer, the end consumer, the mortgage person, the person looking to buy a house.
Oh, I agree with you, and we talk about it all the time, and how are you supposed to compete in a market where prices are rising, rates are rising, yet your income doesn't significantly rise to match that, and as you say, 70% affordability index down in Orange County, that makes it tough.
It does. I guess right now, the one thing that I probably, if I had to stress to, if one of my children was buying a house right now,
right,
I would tell them before they ever looked at a house to go speak with a mortgage broker and get pre-qualified on a to be determined. So they don't have an address, they just have a county or a city that they want to look at buying a house.
Right.
Because the income, the credit, the assets, everything can be underwritten, and you know what your dollar will buy you.
Right.
You have an actual approval, a commitment from a lender that says, hey, if you buy a house, it's a decent house, and it appraises it with the purchase price, we'll close your loan, because we know income, credit, and assets, you're fine.
You know, I've been telling people, because of the affordability issue here on the West Coast, and it's all up and down the West Coast. It's just not in Orange County. It's in L.A. County, Ventura County, even as far in as, the Inland Empire, where the show's being broadcast today. Yeah. Tell us, what are you seeing nationally from your company? Because you're a national player.
We are. We're licensed in all 50 states. It's interesting is different areas, the inventory is significantly lower. So what we're seeing a lot of people do is they're refinancing their homes and either pulling money out or doing renovation loans to actually update their house from the 70s or 80s or 90s to current decor.
Right.
We're seeing a lot of that. and then we're not seeing as much of the move-up market because the inventory is not there. But the credit scores are much higher.
Right.
And the
Oh,
down
that's a good thing.
payments are more significant now, too.
Now, is Remen expanding their QM portfolio? I mean, are they going up to 50% DTI? Are they trying to do some other things to expand the pool of borrowers?
So the truth of the matter is, yes, and I would imagine that every lender is doing that.
Right.
The bucket has gotten so small for a 45 back end, 5 or 10% down borrower that you have to expand your program guidelines. You have to be working with somebody who actually understands the difference between Fannie Mae and Freddie Mac.
Mm-hmm.
There are borrowers that you put on a Freddie Mac specifically because of the way they get paid.
Right.
Then there are times where FHA is even a better loan. Sometimes when you look at, you read about these the Home Ready program.
Right. Great program.
It's a great program,
right.
But when you price out a Home Ready and the MI on the Home Ready, sometimes a 3% down or a 3.5% down FHA loan is actually a better loan when it comes to the dollar being spent by the borrower.
Because of the MIP is less with the FHA loan than it would be on the Home Ready program?
Correct, plus the rates are less on FHA. So you really need to talk with somebody who knows all the loan programs, because ultimately your house payment is $1,500 or $1,530 as a consumer. You don't really care what kind of loan you have, as long as you
right.
understand the terms of it.
Right.
What you care about is, am I spending $30 extra or not?
No, that is true. And I think a lot of consumers look at their monthly payment as the determining factor of what kind of loan they're going to get.
Correct. And a lot of consumers will beat up the car salesman when they're trying to buy a car, but they don't put the same energy or effort into a mortgage.
Well, I think there's still the conception out there, or misconception, that getting a loan is difficult. And I try to tell people, it's not as difficult as you think it is. I think the misconception through 2011, maybe even 2012, it was more difficult. But we're at 2018 where lenders want to lend money. I mean, they have to lend money. I mean, we're going to see consolidation, or some companies even going out of business. You saw that 2 title companies, one's buying another. Fidelity's buying Stewart. So
Correct.
If consolidation is happening in the title business, it's certainly to follow in the lending business.
It actually has been going on in the lending business, I want to say, for about a year and a half now.
Right.
There have been some big mergers that have happened. And the non-QM products are starting to come back.
Right.
And that is indicative of, for example, Orange County's 17% affordability.
Right.
You have to look at non-QM products. And the rates on the non-QM products have dropped down to about 3/4 higher than a regular Fannie Mae type loan.
Right, and that's what I was going to say. Is it 3/4 to a point? Is Remen in the non-QM space as well?
We are.
Okay.
We are.
What are some of the products that you're doing?
Well, so we have a 24-month bank statement or a 12-month bank statement. We also have profit and loss, asset liquid depreciation, or depreciation is not the right word.
No, it's it's an asset-based loan is really what it is.
Yeah,
And
basically
you're working off of P&L.
You're working off of the P&L,
Right?
Because now you have to keep in mind those are for consumers generally who are self-employed,
Right.
and they're putting money down on their house. They're not looking for maximum financing.
Right. What do you consider putting money down? Over 25% or 25%?
20 to 25.
Right.
I just received an email today that we're going to do bank statements to a 90 with
Wow.
no MI.
Wow.
I don't know what the rates are going to look like on that because it doesn't come out till Monday. But when you see these expansions in your non-QM products, excuse me, the lenders only do that because the market share has dropped significantly.
Of course, and people have to develop products in order to survive. I feel it on my end, absolutely, and I'm a small-time player, so I can imagine the overhead for a company like yours or, one of the big banks is just exorbitant.
It is. And the margins have gotten slimmer, so you have to look at if if I was a consumer today buying a house, or if I have been putting off a refinance on my house over the last year or two,
Right.
I would very much be looking into that issue between now and tax time.
Hey, listen, Brian, we're up against the clock. I apologize for that. I'm kind of interested in more of what you had to say. Would you do me a favor and shout out your phone number in case somebody wanted to get a hold of you with some of the interesting things you're saying?
Certainly. My phone number is 949-529-7366.
Thanks very much, Brian. And this has been Brian Hewitt from Real Estate Mortgage Network, REMN. Thanks very much for coming on the show.
No problem. You have a good day now.
And you too. Thank you very much. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Telephone number is 888-713-2929. Pick up the phone, give us a call. We can talk about your mortgage. We can talk about what you want to do this spring. We are in the spring buying season, selling season, or at least pretty soon thereof in the next couple of days. So if you're out there and you need help, and I'm sure you do need help with figuring out the financing, or let's say you're a seller of a house and you're trying to figure out whether the loan information you've received on a contract to buy your house is legit or not. Hey, call me up, email me, info@malibufunding.net. I will be happy to give you my opinion or give you some advice as to what you should ask the buyer's agent or the buyer themselves as to their financial qualifications. Look, there's only a few things you really need to have verified. One is the credit score. Obviously, that's going to impact a lot of their credit decisions. Two is the rate that they're quoting on their either approval letter or in the contract itself. Is it even being offered? Three, do they have a steady employment, and can they continue to obviously pay for the mortgage? Because that's going to be determined as to whether they're going to be able to get a mortgage, right? You can't say that, hey, I've got this great job and I can get a mortgage if the job ends next week. For instance, those people who are self-employed. And by the way, we just talked to Brian Hewitt over at Remen. He was talking about a lot of new and different programs coming available because for lenders to survive, we talked about it last week, they need loans. And if you don't have lenders that survive, you're not going to be able to get competition in the mortgage marketplace, and therefore very few or fewer players will be able to control more of the market space. So in order to expand the pool of loans out there, different types of loans, and this is what Brian was saying, different types of loans are going to be offered, whether it's bank statement loans. And he said we're going to go back to 1998 programs, 1998 type of loans that we're going to have in the marketplace, what they used to call Alt-A. Now, there are A-paper loans, and we talked about it earlier on the show. A-paper loans are a certain type of credit score, a certain type of a borrower that makes X amount of dollars, people that have been at their job for a long time, good credit score, those are A-paper. Alt-A are the other kind of people, good borrowers, but not necessarily W-2 employees. If you have 24-month bank statement programs, i.e., I've got deposits coming into my account every month for the last 24 months, chances are you're probably going to have them for the next 24 or be able to pay your mortgage. These type of loans will carry with them a little bit higher rate because there's a little bit more risk. But as Brian said, those rates have come way down. The non-QM product, oh my gosh, they used to be 2 points higher at least. You used to get a non-QM loan when rates were 3.5% on a 30-year fixed. Those non-QM loans would start at 6.5%. If you could get a hard money loan at 8-9%. Well, now these non-QM products are much more competitive with your basic program, which is now 4.5%. So you're going to get a non-QM loan at 5%. That's pretty good. And those people who are looking for, we have a foreign, a foreigner loan, meaning that if you are from a different country, if you are from, like, let's say we do a lot of these loans down in Florida, Brazil loans, whereas a lot of our borrowers are from Brazil, they're Brazil nationals, and we have programs that can help people who are not citizens, but who have certain information or certain documentation, whether it's a TIN, which is your tax identification number, or whether you're a corporation, or whether you can prove assets in a different bank in a foreign country through letters from that bank. Yes, we can get you a loan. There are a couple of lenders that we work with. We are a lender, of course, in the state of Florida. However, we do use other lenders as well. So we are not the type of company that would go out there and say, no, we can't do that loan, push you off. Whereas, as I was saying earlier, in the A-paper loan, yeah, that's what they do. They'll push you off because they don't want to deal with you. And because of the nature of the way the lending industry is right now, any loan can be a good loan if it's worked by somebody who really wants to help you. And in that smaller companies are those type of companies that need the loans, but more importantly, have to help you in order to ensure their business. They have to stay in business by helping people with more difficult type loans. Okay, I want to get to real estate security. Real estate security in terms of documentation, and I wanted to bring Daryl on just to ask him a little bit about his thoughts on keeping people's information secure. We talk about it every year, and I want to talk about it today because, as I said, there's be more pressure and more, I guess, information traveling across the internet this year than ever before. Yeah, Daryl, your thoughts on it, and what do you think some of the top risks are in transmitting information over the internet?
Well, first of all, people are now referring to the dark web, right?
Oh, yes.
Experian and these guys. First of all, wasn't Experian, they were the one with the big leak, right?
Well, they've had another leak. It was last week discovered.
And now they've got this big ad campaign going on television where they will help protect your information and let you know if it got to the dark web, although they're the ones that put it there in the first place.
Well, first of all, if they're the bad people, they have to point out somebody else who's even the worst people, the dark web.
The dark web, yeah. It sounds like something from Batman, damn it.
Exactly right. When Experian shows up with a guy with a cowl, I'm really never going to use them again.
Yeah, scary.
It is very scary. Okay, so I went. There's a magazine that comes out to the realtors each and every month called Realtor Magazine, and they
Sounds appropriate.
Yes, exactly. Makes a lot of sense to me. So the National Association of Realtors and the California Association of Realtors, which are two of the many organizations that we belong to, they sent out an issue, and they talked about 5 different or 4 different things that they consider to be risky when we're dealing with real estate contracts, which, of course, anybody that's getting a loan is purchasing a house. You know that your real estate contract is very, very important. And they pointed out 4 different things.
Credit card information, obviously.
Well, credit card information, yes, absolutely, is one of the issues because, now, the chip, right? Let's talk about the chip for a second. So about a year and a half ago, all major credit cards came out with a little chip. Now, you go into a store, you go into any retail establishment, and you either slide or poke the chip in. How many places, just curiously, have you been to, Daryl, that don't accept the chip, that you continue to have to slide?
There's a few places that have the machines, but it says
chip's not available.
Piece of a cardboard in there saying don't use this.
Exactly, and it just drives me crazy. I think that there's whatever the standard is, let's use the standard. But that's one of the issues of safety.
Even if you put the chip in there, they still ask you to put in either your PIN number or the 3-digit code from the back of the card in anyway. So what good is that chip?
Well, I think mostly what the chip does is it protects you against somebody sliding on a slider. I guess there was a lot of retail theft when the attendant or the person who took your card went to a different machine and slid it through and stole all your information and then either sold it or used it in some nefarious way. I think with the chip, what it really is that you watch your card the whole time.
So it's really you. It's really
right.
Your
it's
card.
Just whatever information is being given, you see it's the card. I'm not really sure what goes on inside that machine. I've never been really that sure, but generally speaking, if we're following the European model, which what this is the chip is the most secure with your credit card.
Seems to slow things down, and they still are asking for the same amount of information, so I'm not impressed.
Okay, so the main thing that they're talking about with real estate contracts when you're sending them, wherever you're sending them, or your sensitive information on that, is they're saying pay attention. Now, what does that mean? Pay attention to what happens to the information when you write it down on a contract and where it goes, and the email trail or the electronic trail of where that information is headed and how it gets out.
Well, it goes everywhere, I would imagine.
Well, that's the thing is, on a real estate transaction now, there's a lot of different technological tools that realtors will use. There's a documentation service that will track it. There is the escrow company that will track it. There's the title company who will track it. There are services which track all of their information and where it all goes out, and that everybody gets the blast of the email. These are transaction software programs which will help you determine when dates are in the contract, when things are supposed to happen with the lender, when inspections are due. But because of the nature of the way all of these companies are working, and I just mentioned 6 of them, that information that is in your real estate contract is, as Darryl said, everywhere.
And all of these companies must have a few gruntled or disgruntled customers, employees at some point in their life.
What is a gruntled? I know that
Well,
there's
in order to be
disgruntled.
disgruntled, you have to be gruntled in the first place.
Well, I don't want to be gruntled, although it sounds like it's probably a positive thing. If you're disgruntled, it means you're not. So if you're gruntled,
Hey, you got to be happy.
you got to be happy. I mean,
Smile on your face.
I'm picturing a Grinch.
Yeah.
Gruntled Grinch. That's
Yeah.
what I'm looking
Whistling going down the street.
at. Exactly. I don't know if that's trouble. So when you're looking at the real estate contract and you're giving it back to your agent because you just signed it,
Yeah.
or you've signed it electronically, pay attention to where it goes. Maybe even ask your realtor, hey, where is all this information going? And I need to be protected somehow. Okay, so anyway, I'm Jeff Barton. I really appreciate everybody listening to the show each and every week. The people at KCAA, KMET, the Roadrunner, and of course, K-Tahoe. I want to thank those terrific people in all those places for bringing the show to you. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.